All right, so let's talk about everything that Kashkari just said, because one of your next guests says that high tariffs should keep inflation firm. They could slow economic growth and force the Fed to be on hold this year. In other words, not cut interest rates. Joining us now is Michael Gapen. He is chief U.S. economist at Morgan Stanley. We're also joined by Steve Liesman. And Steve, I want to start with you because is there a school? I know we talk about inflation and tariffs a lot, and tariffs certainly seem inflationary. But is there a school of thought whereby tariffs may actually cause prices to go down, not for a good reason, because they could kill demand?
Sure. I mean, that's part of the reason that Goldman Sachs is saying that they expect a one-time, they said this over the weekend, a one-time price increase from tariffs because of the idea that you're going to have weaker economic growth. And that seems to be the consensus on the street. In a sense, Brian, that's obviously a bad thing, but the good thing about it is it shows that the economy would work. This notion of stagflation is sort of an aberrant state. You shouldn't have it. You shouldn't have prices rising at the same time that the economy is weaker, because a weaker economy is supposed to take care of higher prices. So we could have a deflationary, or rather disinflationary impulse from tariffs if indeed we do have weaker growth, which is not obviously the best reason to have them.
Michael, do you see stagflation ahead, kind of the worst of both worlds?
Yeah, we do, in the sense that we have growth slowing down to about 1% this year. You may have a couple of quarters maybe where real spending is flat. So at least in terms of growth rate, lower. And as Steve said, tariffs should push inflation higher, at least through the end of the year. And so you get, again, another temporary or hopefully transitory increase in the rate of inflation. But yes, if you push this too far, as the economy, or as I'd say markets thought we were, say, at the beginning of April, then you risk more of a sudden stop in trade, a much sharper decline in activity, and then maybe in that world, the price level actually comes back down. We don't think that happens. We think it's just more slower growth and stickier inflation that's firming between here and the end of the year.
Because, Michael, and I'll go back to you, let's say if you've got something you have to buy, you don't have a choice, you're going to have to pay the higher price. But if it's a good that you don't really need, but maybe you want, let's call it a shirt, and the shirt is $40, and the tariffs bring the shirt to $50. Making the numbers up, but you get the point. If you don't pay the $50, you decide it's not worth it, I don't really need the shirt that bad, at some point the shirt manufacturer will have to continue to lower prices until somebody says, okay, now the shirt is worth what I wanted to pay for it.
Or they decide that it's not economically feasible to produce that shirt, and then you get layoffs. So yes, but that's you're right that there's a non-discretionary point or part of the consumer's basket, and they have to pay those higher prices. That leaves them less to spend elsewhere. So then it's how the private sector reacts to that, which means the inflation that you see out of tariffs may abate or reverse, or you get firms engaging in cost control, outright cuts in spending and outright layoffs. Again, we're not seeing that right now. The answer is pause and wait. Let's see how this evolves. Let's see where the end game is, as Neil Kashkari said. So right now it's a pause story. It's not a cost cutting or layoff story, but we'll see how it evolves.